Hello everyone, let me introduce myself. My name is Albert Nathanael and I am an undergraduate management student at Bandung Institute of Technology, Indonesia. Today I would like to present an academic paper written by me and my supervisor Dr. Yunieta Andin Nainggolan for the second International Fields Role Conference on Education, Social Sciences and Technology 2022. The title of our paper is Interactive Social Media Platforms and Stock Market Participation during COVID-19 pandemic in Indonesia. Here is the content of today's presentation. The first section will introduce the background research of why this topic is studied. In the second part, we will discuss what's the problem that we would like to address so that we can find a solution to solve the problem. Next, we will state the research questions and the objectives of this research. Then we will deliver the hypothesis development based on the literature review that we have done. Next, we will discuss the methodology such as statistical analysis, data collection, and any other related things to examine the hypothesis. The last two parts will cover the results of the regression and give the recommendation based on the results. Stock market investing is no longer a taboo topic among Indonesian people. Indonesian people have become more aware of the value of investment in recent years. According to data from the Indonesia Central Securities Depository, the number of domestic retail investors in the capital market surged dramatically between 2019 and March 2022. The highest growth rate was 92.99% in 2020 to 2021, with a total of approximately 7 million investors. Not only that, the data given by Statista also shows that the internet users and the active social media users will grow constantly until 2026. The reasonably rapid growth shows that Indonesians have adopted the internet or social media as an essential aspect of their lives, whether to seek new information or for other purposes. Therefore, it is an urgency that the government or any other institutions must provide a well-constructed and high-quality financial education for the young investors in order to prevent them from falling into the financial trap. These two facts become the opportunity for us to do this study. The COVID-19 pandemic's emergence caused significant uncertainty for stock markets throughout the world, according to Ozili and Arun 2020 and Contesi and Apache 2020. As a result, every industry has suffered harm, and the majority of stock market indices globally have had their largest one-day drops on record, according to FASU 2020. This also impacted the Indonesia stock market. The COVID-19 pandemic in Indonesia had an impact on the stock market and changed the trading hours on the Indonesia Stock Exchange. As a result, investors become more interested in selling their shares as a result of this negative signal, according to Kusnandar and Pintardi 2020. The COVID-19 pandemic has also had an impact on stock market dynamics, leading to a drop in stock exchanges globally and a rise in stock market inefficiencies. This also has a detrimental effect on Indonesia's stock market and affects investors' decision making, according to Pitaloka et al. 2020. The government must act right now to restore the stock market situations in light of this issue. As younger generations begin saving and investing, social media will continue to have a significant impact on the financial markets. Both possibilities and threats exist in this. Online conversation and information exchange can increase market efficiency and openness. Anu Gagar 2021 claims that social media platforms in particular are a powerful draw for younger investors who frequently rely on them as their main information sources. Social media is a financial inclusion since it has a connection to stock market participation and serves as the main information source for investors. The impact of learning from social media platforms on stock market participation will be investigated in this study. In order to give an unbiased result, the researcher decided to divide social media into two categories. The first one is social networking site, which for investors who solely learn and get information from social media platforms independently. and online stock communities for investors who learn and get information from online stock communities. Therefore, there are two research questions. The first one is how do learning from social networking sites impact the stock market participation in Indonesia's stock market during COVID-19 pandemic? The second one is how do learning from online stock communities impact the stock market participation in Indonesia stock market during COVID-19 pandemic? Based on those research questions, the research objectives are to know the impact of learning from social networking sites and online stock communities on stock market participation during COVID-19 pandemic in Indonesia. According to Wu et al. 2017, financial social platforms have become an effective avenue for investors to engage with one another and get insights into financial market trends. In addition, social networking sites promote stock market participation according to Calvet et al. 2006. Therefore, our first hypothesis is that learning from social networking sites has a significant impact on the stock market participation during COVID-19 pandemic. Community effect positively affects stock market participation according to Brown et al. 2004. While investors are more inclined to participate in the stock market if they are more involved with their neighbors, according to Hong et al. and 2004. Because of that, our second hypothesis is that learning from online stock communities has a significant impact on the stock market participation during COVID-19 pandemic. The researchers selected to use a primary data source to achieve their research goal. This is because the objective of this study is the effect of social media platforms on stock market participation during COVID-19. It might vary over time. As a result, the primary data source is appropriate for this study because it will provide the most up-to-date results. An online questionnaire was sent to Indonesia's retail investors to collect the data. The population of this research is Indonesia's domestic retail investors who invested in the Indonesia stock market during COVID-19 period. According to the Indonesia Central Securities Depository, the population of Indonesia's domestic retail investors per March 2022 is approximately 8 million investors. The researcher used a non-probability sampling method. The reason for using a non-probability sampling method was that the researcher had a limited time constraint and cost constraint. In other words, it was easier to access than the probability sampling, according to Showkat and Parvin 2017. To be more specific, purposive sampling was used in the study. Therefore, the respondents' characteristics that will be examined are: the first one is Indonesian retail investors and has ever or currently invest in stock market. In determining the sample size, the researcher referred to a study conducted by Pujang, Saad, Siddiq, and Lim 2018 where they examined the best rule of thumb for a logistic regression. It was stated that the best rule of thumb of determining the sample size for a logistic regression was EPV or even per variable 50, which the formula is n equals to 100 plus 50 times I, where n is the sample size and I is the number of independent variables. In this study, there are two statistical models that are conducted. The first model is to examine the quantity of social media use, and the second model is to examine the social media choice. In the first model, there are two independent variables, while in the second model, there are 5 independent variables. Therefore, the second model is going to be the baseline for the sample size. Referring to the equation, the minimum sample size is 350 respondents. As I mentioned before, that there are two kinds of statistical models that are conducted in study, where the first one is to examine the quantity of the social networking sites and the quantity of the online stock community that are used as respondents learning channel. Therefore, the first statistical model is as follows, where SNSI is the number of social networking sites for individual I, and OSCI is the number of online stock communities used for individual I to learn about stocks, and CKI is control variable K for individual I, and epsilon I is the error term for logit model. The second model is to examine the social networking site choice and the online stock community platform choice that are used as respondents' learning channel. There are four social networking sites, namely YouTube, Facebook, Instagram, and Twitter, and one online stock community platform, Telegram, that are going to be tested. Therefore, the second statistical model is as follows, where YT, TWT, IG, FB, and Tele stands for YouTube, Twitter, Instagram, Facebook, and Telegram respectively, which used dummy variable that equals to 1 if the respondent used that particular channel. Otherwise, it equals to 0. The financial literacy questions would assess and measure respondents' financial literacy levels. The objective of the assessment was to know the level of respondents' financial literacy from a particular type of social media. In other words, the researcher will see the level of financial literacy of respondents who came from every kind of social media. Although financial literacy acts as a supporting or additional data, or in other words, it did not include as the main objective of the research. The researcher believed that the financial literacy result would play a huge role in giving the insightful recommendation to the policymakers. The questions covered time value of money, interest compounding, capital market, and investment risk. These questions were adopted from a study by Farnby et al. 2011. The study managed to obtain 362 respondents. Table 1 summarizes the number of social media platforms used by the respondents. The respondents used 2 social networking sites and joined 2 online stock communities on average. Meanwhile, the biggest number of social networking sites used and online stock communities joined are 4 and 6 respectively. According to Figure 1, YouTube was the most popular social networking site among the respondents. It is proven by 39% of the total respondents who used YouTube as their learning channel to seek investment knowledge. It is followed by Instagram, which is used by 32% of the total respondents. On the other hand, Facebook was the least popular social networking site to be used as a learning channel. From Figure 2, it can be seen that joining online stock communities has been quite a popular way to learn about investing. 64% of the total respondents joined at least one community. In contrast, 36% of the total respondents did not join any online stock community. Meanwhile, from Figure 3, Telegram was not more popular than other digital platforms as the media to join the online stock community. Only 28% of the total respondents joined online stock communities through Telegram, while the other 72% of the respondents chose other digital platforms to join online stock communities. From Figure 4, it is clear that most of the respondents managed to score 4 out of 6. It is approximately half of the total respondents were able to score above 3. However, the average financial literacy score that all the respondents had was 3.39 as shown by Table 2. Based on the interval calculation where 0 until 3 is categorized as low financial literacy level, therefore it can be concluded that the respondents still had a low financial literacy level. From Table 3, most of the respondents had the understanding of interest compounding or FL1, mutual funds or FL2, stocks or FL4, and asset diversification or FL6. On the other hand, most of the respondents still did not have the correct understanding regarding time value of money or FL3 and long-term investment or FL5. Tables 4 and 5 provide the model fitting data for both models, comparing the models with and without explanatory variables in terms of how well they match the data. This is done in order to explain how the model's explanatory variables have an impact, given that the significant chi-square statistics p-value is less than 0.05. It can be concluded that the both final models significantly outperform the intercept-only model. Moreover, Hosmer and Lamshaw test results of both models indicated that both p-values exceeded 0.05. In other words, we can reject the null hypothesis which means that the models were good fit. Based on tables 9, it can be seen that almost all variables are proven to significantly impact stock market participation. In the first model, both the number of social networking sites or SNS and number of online stock communities or OSC positively promote stock market participation. For every 1 unit increase in social networking sites or SNS, it is expected to increase the stock market participation by 1.701. This means that if the respondent adds one social networking site as a learning channel, it increases the probability to invest in the stock market by 70.1%. Meanwhile, for every 1 unit increase in online stock communities, it is expected to promote the stock market participation by 1.202. This means that if the respondent adds one online stock community as a learning channel, it increases the probability to invest in the stock market by 20.2%. This result is aligned with the literature that social media increases the tendency to invest in the stock market. Therefore, it is important to encourage retail investors to use social media as a learning channel. In the second model, YouTube, Twitter, Instagram, and Telegram are proven to positively impact stock market participation. If the respondent uses Instagram as their social networking site choice, it increases the probability to invest in the stock market by 68.1%. Meanwhile, if the respondent uses Twitter and YouTube, it increases the probability to invest in the stock market by 63.7% and 2.2% respectively. In addition, if the respondent uses Telegram to join the online stock community, it increases the probability to invest in the stock market by 2.2%. On the other hand, this study fails to prove that Facebook has a significant impact on stock market participation. This result is aligned with the literature that social media increases the tendency to invest in stock market. Therefore, the policymaker can utilize all the examined social media, especially focus on Instagram and Twitter, as the financial inclusion to provide financial education so that the retail investor can be equipped with the right financial knowledge regarding investing. The findings show that the number of social networking sites positively impacts stock market participation. It implies that the more social networking sites are used, the more likely the investor will invest in the stock market. Meanwhile, YouTube, Twitter, Instagram, and Telegram significantly impact the stock market participation. Instagram is the most influential social networking site that promotes stock market participation, followed by Twitter and YouTube. Meanwhile, there is not enough evidence to prove that Facebook has a significant relationship with stock market participation. In line with the number of social networking sites, online stock communities also positively impact stock market participation. It implies that the more online stock communities the investor joins, the more likely the investor will invest in the stock market. In line with that, Telegram as the online stock community platform has been proven to positively impact stock market participation. It means that comparing Telegram to other platforms increases the likelihood of investing in the stock market. The results of this study will not only add intellectually to the literature but also provide policymakers with useful suggestions for creating financial literacy initiatives. From this research, it can be seen that the numbers of social media use promote stock market participation. Meanwhile, it is also predicted that social media users will keep growing in the following years. This is an opportunity for the policymaker to design financial education programs in social media to promote stock market participation. In addition, Instagram, Twitter, YouTube, and Telegram are proven to promote stock market participation. Based on these findings, the policymaker is recommended to utilize these platforms to keep injecting the financial education programs to educate the potential investor to give them proper fundamental knowledge regarding stock investing so that they do not fall into a financial trap. If the investors are well educated, the stock market will also be healthy and it will positively affect the country's economy. Since this study only includes social media, the future researcher can also include the financial education applications such as Ternak Uang to examine its relationship with the stock market participation. Therefore, it can give a more comprehensive understanding of the effect of several types of digital platforms on stock market participation. In addition, the study failed to prove the hypothesis that Facebook has a positive impact on stock market participation. Due to this reason, the future research can enlarge the sample to capture the effect of Facebook on stock market participation. That's all from me. Thank you for your attention.